terms of returns for the investors, SIPs are golden.
We've seen that mutual funds and SIPs, they have crept into the everyday life of Indian middle class.
The number is still not as how it is in developed market. Now we are at 4 trillion GDP. We expect in the next few years to be 8 trillion.
Investors usually just chase returns and they pick their fund. What do you think they're doing wrong?
Just looking at the outcome is only 10% of the game. Idea is you want to judge the process. You don't want to judge the outcome alone.
Do you think the rise of passive ETFs say something about the limits of active mutual funds?
We want to be lesser and lesser dependent on a human to take a decision. My view is that the passive side could show some large amount of outperformance because of process and fees.
Accountability would reduce some of the underperformance of active managers.
Maybe we should make it compulsory for fund managers to disclose their portfolios.
The problem is there are so many mutual funds. What's the right one for you to be investing in?
Welcome to another episode of Leverage by Qode, where quant thinkers take the mic and we try to decode the markets. Today's episode, we're going to talk about mutual funds, how they've become an institutional backbone to retail investing, how you can review your own mutual fund portfolios, and SIPs, how they've changed market structure. Today, I have Rishabh and Gaurav, our fund managers from Qode, for this discussion. Welcome, guys.
Thanks, Pratik.
Thanks.
So for a lot of the years in Indian markets, retail investors have either speculated or stayed away from markets altogether. But we've seen that mutual funds and SIPs in particular, they have crept into the everyday life of Indian middle class, has become an integral part. So how important do you think you see this trend creating discipline around investing and the right way where people can invest in markets?
The idea is definitely right. We want more, Indians to be doing a more systematic investing rather than taking calls by themselves about which stock to invest in. If I just compare that to, let's say, 20 years back, the number has grown significantly. And today, I would say the number is still not as, how it is in developed market. So I think we're moving there, but, we've still not reached there. Today, there's about 80 lakh crore in, total mutual fund market. About 10 years back, that was about 12 lakh crore. So we have grown significantly, but I think there's still room for us to grow from here.
I think what's also happened is that over time, right, like the numbers are very large today, at least on the mutual fund side. Though if you compare this to the developed countries like the US, the numbers seem really small, right? But I think it's sort of in line with the businesses that are available to invest in. I know like a lot of times people would be like, okay, this number in terms of mutual fund investing will keep growing. But at the same time, we need to keep in check that, there are enough businesses also that need to be capitalized. I feel like, at least on the sub 20,000 crore market cap, there are fewer businesses and, float is not so easily available. So it becomes hard for mutual funds to allocate that capital. So as the trend keeps growing and as, the government as well as mutual funds are promoting mutual fund investing, I think there needs to be a large initiative on the business front where there are enough businesses also being capitalized. And that's how we saw the NSE, SME, the emerged platform that came up where even small businesses are being promoted and, asked to come to the public markets to sort of raise capital.
Makes sense. So there's now supply matching the demand of the money that's pumping into markets. Absolutely. But even then, if you look at the data, as you rightly said, like we're still in the nascent stage. Bulk of the money in India is still invested in real estate, gold and debt. Like if you look at assets, equity is still ranked quite low. Right. So how important do you think that removing that emotional decision making to investing and timing the markets and just doing it as a process has been very crucial to this adoption of, SIPs and then the way people invest?
So the idea of, I would say, SIPs working, think of India 20 years back, let's say 2005, were, when there were less corporate jobs, there was less stable income. What has happened is, for the last 20 years, more companies have come to India. There's internal, startup culture building up as well. So a lot of people have a fixed income being, coming to them. And because of that, people have been investing that in the market as a, fixed amount every month. So we expect, that amount to increase over time. Second way to look at it is the market in general. Now we are at, let's say, 4 trillion GDP. We expect in the next few years to be 8 trillion GDP. So people are looking that as an attractive option, saying, I am getting money on a periodic basis and I need to keep investing it. That's why I'm choosing, the Indian equity markets. And as we mentioned before, the penetration levels are very low. I would say the number of companies that are investable, that number is less, but as we speak, the number is increasing every day. More people are coming up with like plans to list their companies on an IPO. I mean, there's a flip side to that as well. A lot of people are cashing out on companies that they've always invested in. But I think India will also need to look at moving away from promoter-led businesses to management-led businesses. In other countries, you will see that promoters might not necessarily be the management. So a lot of the times people end up looking at it as a negative, saying promoters are cashing out. But if they still have a plan of running the company in a particular way, I think there's room for India to absorb that.
Right. This is a trend that people talk about, like, historic levels of promoter selling. But like, if you don't have that supply side, like, how are you gonna participate in markets? So I think that's not a negative; it's probably a positive. So let's talk about SIPs, right? The nature of SIPs with money coming in every month, irrespective of where markets are. Do you think that's made our market more stable, or it's more, less susceptible to those big crashes or drawdowns that we used to see before 2016? So how do you see market structure has changed because of SIPs?
I think what's happened is that definitely, to give a straight answer, yeah, markets are less volatile compared to the US markets or other nations. If you look at Nifty in particular, I would say at least on the large cap side, we're seeing like much lower drawdowns. For markets to be down like 10-15%, the numbers have to be very large, and we're having that inflow, right? 25-30,000 crores a month keeps getting added and keeps getting pumped. So even though we've seen that FI exit, but domestic institutions adding that definitely adds to some sort of cushion to the markets. In the long run, I don't think these numbers matter as much. What actually matters is whether earnings growth is going to come or not, right? So ultimately, there are a lot of discussions around the FII, DII numbers, but all of this is driven by earnings growth, right? Ultimately, like, if the businesses are going to show earnings growth, you will get FIs as well as DIIs to invest in the markets over here. To answer the second part is, in terms of SIPs actually bringing stability as well as sort of, in terms of returns for the investors. I think SIPs are golden because it sort of, helps you to save money. Today, because of SIPs, you could put it as small as a 500 rupee amount and keep saving that. And I think that gives the opportunity to everyone, on a retail level, on a mass level, especially in a place like India, to participate in the markets, right? Even with because if you had to do direct stocks, you wouldn't think of doing anything with 500 rupees. The discipline would not be there. Today, with the advent of apps like Grow, Zerodha, it's become really easy for absolutely anyone to open an account, invest that money. So I think in terms of habits, it's amazing, right? Because the next best option for most people would have been like a post office savings account or a PPF, right? So, and the returns are not matchable in any way. So I think, having mutual funds, the government promoting it has actually shifted, household savings towards equities.
And I think there are very a lot of indirect ways as well that the government is trying to promote selling mutual funds. For example, let's say if you've invested in a mutual fund, it's possible the mutual fund churns their portfolio within that year. As an investor, if I was to do that, I would have to pay short-term capital gains tax, which is 20%. But if I'm invested in the mutual fund churns it. If I hold the units for the mutual fund longer than a year, I'm still paying long-term capital gains tax. So it's still giving me that advantage. If I have that long-term view, saying I want to be invested in this mutual fund for longer, I'll end up paying long-term capital gains tax even if the portfolio gets rechurned. In fact, there's another interesting thing that has happened. Let's say if you invest in a particular mutual fund and mutual fund charges you an exit load. Exit load is any investor who's leaving the organization, leaving the mutual fund, and maybe taking their money out and investing it somewhere else. They get charged a particular fee. Now, intuitively, you would think that the fee goes to the fund house or goes to the fund manager in a certain way, but actually that does not happen. The additional that fee that the AMC gets added to the total pool of the investments. So let's say I'm an investor who has invested for more than a couple of years. But there have been other investors who've left the scheme, periodically and paid an exit load. Indirectly, I end up getting benefited from that situation. So I mean, for me, it's even more lucrative to stay invested in funds, for a longer period of time.
Absolutely. Even like the marketing campaigns of mutual fund sahi hai and all of those things that we see, everything is in the direction of getting like, getting large population benefited out of this entire investment category. Now the mutual fund portfolio of investors. You know the nature of investors, they usually just chase returns, right? So they just look at the returns and they pick their funds. What do you think they're doing wrong when they do that? What are the other things they should look for when choosing a mutual fund?
I think step number one is like, first, creating the habit of investing, doing SIPs. And, now coming to this step, I think this is very interesting, this entire space, right? Especially the mutual fund space. Because you're right, the way people invest in mutual funds is, you go to any website and then what you do is sort mutual funds based on performance, 1 year, 3 year, 5 year, etc. And then you take the top, 3, 4, 5. I think what also happens is, what's the first phenomena at play over here is survivorship bias. There are probably, 800,000 or more schemes.
1,000 plus equity schemes.
Right, 1,000 plus equity schemes. And if you look at them as independent portfolios, you're going to have a survivor, someone who has done extremely well even in a bad market. And then you end up investing in that fund. The thought process behind any investment, whether it's a mutual fund, a PMS, a hedge fund, whatever you're doing, right? Idea is you want to judge the process. You don't want to judge the outcome alone. I think outcome does matter. It sort of gives validation to the process, but just looking at the outcome is only 10% of the game. The rest of the game involves, knowing, okay, fine, what is the process? How has the investments been made? What have they been doing in terms of, valuation models, growth models, etc. And now it's not like fund houses don't provide this information. If you dig a little deep, it's not even a lot of work. If you go to the fund website, if you actually look at the offer document, you can even write an email to the fund itself, and there's a lot of information available behind every scheme that's out there.
Now SEBI's made it so that they have to share rolling returns also, something which is a much more nuanced way than just looking at trailing returns, which like mutual funds have to comply.
Absolutely right, because see, you want to be aware of these things. I remember I faced this problem where when when I was in college, I invested in some mutual funds, and then over time I didn't even realize the mutual fund, the scheme name changed and the thought process of the mutual fund changed, and there was one fund where the fund manager changed 3 times. So when I invested in the fund, there was some thought process, and then over time the thought process, the fund manager, even the fund name, even like move from like say a small cap to a flexi or a multi cap fund. So you need to be aware of these things. It's not like, oh, you invested, you did an SIP, it's autopilot. I think that periodic review, maybe a quarter, 6 monthly, would really change the way you're actually investing. So one of the examples that I generally give is back in 2016-17 when I was looking at mutual funds. The Parag Parekh Flexi Cap Fund, right? I think that was one of the funds that they had back then. I think their thought process was very, very clear. In fact, even after investing in the fund, they sent like a brochure home with all the details of how they end up investing. And if you even look at their logo, they have I think a turtle or a tortoise on as the logo. And there, they put in all their thought processes. Late Parag Parekh had also written a book on his thought process of how he goes about value investing. So the thought process is very clear that we will do value investing, we will work on behavioral finance, and that's it. There is nothing more than that. So you want to approach more such funds. You also want to realize, right? So when they started off, for example, it was like a really small fund, like a 5-10,000 crore scheme, and today it's at a 1 lakh crore. So there are challenges even today with funds like these. So looking at all these factors and then deciding where you want to put your money is extremely important.
Yeah, I think, we spoke about the merits of mutual fund investing. What has happened is 20 years back, people were investing by themselves. They didn't have that exposure to investing in equity. And I think it's a great thing that people have moved on to mutual fund investing. But the problem about, mutual fund investing today is that, whether you're betting on a particular segment or you're betting on a particular fund manager. When I'm talking about that, the example that, Rishabh gave, Parag Parekh Fund, now at this moment, they are holding about 20% in cash. So for example, if I am the one deploying my funds, let's say I've deployed 1 crore rupees, I've given it to Parag Parekh Fund. Now 20 lakhs, they're holding it in cash. If there was a cash call to be taken, it's possible that I would have said, hey, I'm already maintaining my cash allocation, so you don't need to do that for me. What you need to do is invest it in the market, the money that I've given you. So a lot of these fund houses, deviate slightly from what the investors could be expecting them to do. It's possible that there's a bunch of investors who are not taking these calls and would want the fund manager to be taking those calls for them, so which is great in this case. But I'll tell you, investors over time are evolving and they have specific needs, that this is what I want with 20% of my portfolio, this is what I want with 30% of my portfolio. Let's say if I want a 20% allocation on, let's say, flexi caps, or let's assume small caps. I invested in a small cap fund, then I realized that they're not holding the required amount in small caps.
Yeah, I remember we were looking at one small cap fund which was
Absolutely.
holding the largest company listed.
Absolutely. So if you look at, let's say, Quant small cap fund, now it is the third or fourth highest in terms of AUM in small cap category. 10% of what they hold is Reliance, which is the biggest company in India. 5% of what they hold is Geo Financial Services. So 15% of their holdings is the large cap segment. Now, if I decide to allocate money to a small cap fund, I don't want to be, taking a call on large cap allocations, because maybe I've, invested in funds in, large caps already. So, what is also happening because of this is, as investors are realizing this, they are trying to take specific positions. Maybe it is, an ETF. It could just be a small cap ETF that I could invest in, which also, there are benefits of doing that. It comes at a lower cost. It gives me that allocation. It helps me bet on the small and mid-sized companies within India without letting the fund manager take a call on what needs to be done with my money. Just to give you a stat, in 2015, about 1.5% of the funds were in passive funds. Today, that number has gone up as high as 15 to 17%. So the understanding of people of these different instruments, it's increasing. People want to take these subjective calls. Maybe they have an advisor in between who's helping them take these calls, but it's definitely improving. Coming back to some other, there are also some restrictions by SEBI, which is not, let's say if we talk about a flexi cap fund, what SEBI says is that 65% of your money should be invested in equities. Rest 35% can be invested in whatever else. It could be cash, it could be some bonds, it could be other debt instruments, and across equities it could be large cap focused, mid cap focused. So it could be anything. So one, I would say, flexi cap fund could look like a heavy large cap allocation. One flexi cap fund could look at a heavy small cap allocation. Then you're not betting on the fund, you're betting on the fund manager. And like as Rishabh said, every 2-3 years the fund managers also keep changing. So what we fear is the mutual fund investing will become like how stock investing was 20 years back, where people are taking a call on the underlying without really knowing what they're investing into.
Right. I mean, in terms of options, it's already in thousands that they have. So it's like going to become as complicated. So you need to like simplify the process of mutual fund investing. Absolutely. So you mentioned that looking at just beyond returns, right? Looking at the holdings. Let's say one fund can have 20% cash. Another problem that ends up happening when you don't look at what you are holding underlying is that there can be cross holdings, right? So if you're holding 5 mutual funds, they can be holding the same stocks, and you can the illusion of diversification may not be true. So how do you find this concentration in your portfolio, how important it is? Like, what do you see happening? Because that's like one of the common things that we see across portfolios.
Yeah, this is something that we do for a lot of our investors also, right? Like we've been doing a lot of portfolio reviews, and when an investor sends us their statement as to what they hold in terms of mutual funds, stock, etc., it's sort of like an X-ray, right? To them, they're like, oh, according to them, they've diversified across 7-8 mutual funds, but actually, if you look at the underlying holding, a large part would be, say, in Reliance or an ICICI Bank, etc., right? So we end up doing that for the investor and explaining that, okay, fine, you actually end up owning the same stock through just different mutual funds. So actually you've not in real diversified in any way. There are in fact enough tools available on the web to do something like this, but obviously you would want someone to analyze this in depth. I think people are not thinking so far out. This is like third or fourth order thinking, wherein you're trying to understand that, okay, what is the yeah, what do I actually own at the end of the day, right? You're owning on your demat, you end up owning, units of a mutual fund. But other than that, you're not thinking, okay, fine, what kind of stocks do I own? Are they large caps? Are they small caps? Within that also, what kind of sectors do I own? What's the return on capital and something like that, right? So I think that becomes a necessity if you really want to be successful. If you go through all these checks, I think you can be a successful mutual fund investor also.
No, I think Rishabh brought up a very important point. In fact, as we speak, we are working on a Qode portfolio review tool, which investors can use, to understand that portfolio in more depth. Currently, I'll tell you there are many calculators available outside. They tell you, good portfolio looks like 3 large cap funds, 3 small cap funds, 3 mid cap funds, maybe a couple of flexi cap funds. The question is, how do you build that calculator? The way we try to look at it is break it down to market segmentation. For example, if you're trying to look at a small cap exposure, try and just focus on small cap exposure. Small cap exposure someone would get because of different reasons. Large cap exposure someone would get because of different reasons. Don't try to overlap them. So the tool that we are making, it'll have all of their holdings in stock, and the mutual funds that they own, we'll go to a stock holding level and try and see which stocks are they actually holding under that and which segments do they belong to. Now, if you compare all the large caps, whether in my stock portfolio or in my mutual fund portfolio, we'll try and combining that together and compare that to what we feel, large caps, we feel it's made for more stability, stable growth, trying to beat the Nifty. How did it do as compared to that? Rather than try and compare a mutual fund that says it's large cap, but has, let's say, 15% in mid caps, has some debt exposure, trying to compare to that, like that's not something that we want to do. Compare just large caps, apples to apples against large caps. Try and break it up mid caps to mid cap. Try and break it up small cap to small cap. Okay, so let's take this example for HDFC mid cap fund. Now 15% of what they're holding is large caps and 15% of what they hold is small caps. Me as an investor, I want to take a position in mid caps. Why would I want to hold 1/3 of my portfolio in something else? Now let's understand what SEBI has to say for this. SEBI says that if you're a small cap fund, 65% of the holdings need to be small cap, 35% can be something else. If you're a mid cap fund, 65% of your holdings need to be mid cap and 35% can be something else. If you're a large cap fund, 80% of your holdings need to be large cap and 20% can be something else. Now, what's the definition of mid cap and small cap and large caps? How SEBI defines as the first 100 companies that are there, those will be classified as large caps. The next 150 companies will be classified as mid caps. After that, the 250 companies will be classified as small caps. What happens is the market cap, for these companies keep changing as we grow. I would say till 2 years back, we used to run models. We used to classify, any mid cap above 20,000 crores. But today that number stands at 35,000 crores in terms of, market cap. So what has happened is, the entire thing, all the market caps have moved up. Any company to be classified as a large cap, now that number has gone up to, 1 lakh crore. So it's important, for an investor to understand, the risk profile, where they're, investing. So our tool really helps them, understand this breakup. When we say, you're going to be investing in a small cap fund, all the stocks that we are investing ends up being in the small cap category. When we say we're going to be investing in a mid cap fund, the holdings might not exactly be, mid cap, but the end result that you end up getting from a prolonged experience will still be 80% mid cap. Same with, I can tell you, the large cap segment. So we try and do that, and we end up suggesting it to the investor, saying, based on your risk profile, any investor investing, the allocation depends on two things. One thing is the risk appetite that they have. The second thing is the market conditions. We have different models that help them with both and tell them what their exact allocation should be. So we think that telling the investor of the allocation that they should be investing in is better, rather than just accepting their funds and investing in whatever you think makes sense.
So circling back to a stat you mentioned, where you said that passive funds and ETFs, they have seen a big shift in India, and we've seen globally they've become extremely popular. Now, passive funds are seen as, that when active funds are not able to outperform and a lot of active managers are underperforming, that becomes an obvious choice. There is lower fees, there's more transparency, and all of those things. Do you think the rise of passive ETFs say something about the limits of active mutual funds?
I think this is a really interesting topic because we've seen, at least on our end, since we are a quant fund, what we've ended up seeing is that there are a lot of I would say within the passive segment also there are quant ETFs that are doing extremely well. I think where we see personally this industry going is we want to be lesser and lesser dependent on a human to take a decision, right? So what's happening is that with a mutual fund, like I mentioned earlier, that the as the AUM changes, the mandate changes, the fund manager changes. So what you started off with, you don't end up owning the same thought process 5 years down the line or 10 years down the line. But that's not the same with the passive ETF, right? So whether it's a passive or a quant ETF, what ends up happening is that the thought process continues to remain the same. Take for example a momentum ETF, a momentum say 550 or a 150-50. It is going to continue following that same process year after year, quarter after quarter. I don't think so that will change ever. So the thought process behind investing in a passive ETF is having lower reliance on an active fund manager, and having a consistent thought process. So for example, if I were to diversify, what I could do is that, okay, I could buy a value ETF and I could buy, say, a momentum ETF. So both are sort of trying to target different kind of businesses. Even when you look at the overlap, the overlap will be low on my entire portfolio. But if I were to do the same thing with two active fund managers, tomorrow if this fund manager changes his thought process, my overlap could be it could be very large. So I think going ahead, I think the passive side is going to take up a larger share. Also in terms of the fees, the transaction cost, I mean the expense ratio that a passive ETF will have, it is going to be a lot lower than what you're going to see on an active side, right? Because there is a cost to run a mutual fund, and when you're actively managing something like that, there's a fund manager, there'll be like senior analysts, and you'll have juniors, etc. So you need an entire team. If you look at funds today, most mutual funds end up owning 70, 80 or even 90 businesses. To end up tracking those businesses successfully also requires a lot of bandwidth. So yeah, I think passive is going to take over. When we're looking at a mutual fund, I think it's important to align with the fund manager's thought process. A lot of times, we don't know what the thought process, the fund manager is having. I think maybe, I was telling Gaurav as a joke that maybe SEBI should make it compulsory for fund managers to disclose their portfolios, because that will actually tell you that, okay, fine, is there skin in the game? Is he actually following that thought process, or is the fund manager actually deploying his own money in a fixed deposit and asking investors to invest in equity schemes, right? Because you want to back someone who has skin in the game at the end of the day, because then there's going to be alignment. Because when he goes back home at night, he needs to be able to think that, what if there's underperformance, and it's going to directly affect him and not indirectly alone. So I think that thought process.
I mean, accountability would at least reduce some of the underperformance of active managers.
No, you're absolutely right. And in fact, there's a perverse incentive for fund managers. What they end up seeing is, if the market does well, I'm going to make money from my company. If it doesn't do well, I need to have something. So let me invest in something safe. And that's a completely misalignment over there.
Like within the mutual fund industry, no one's charging a performance fee, right? And what SEBI has done is heavily regulated the industry. So what you can buy, what you can't buy, position sizing, etc. And Charlie Munger has this quote, right? Show me the incentive and I'll show you the outcome. If you back someone whose incentives are aligned, I think you don't need to worry about your money anymore.
I think that's an excellent point about like performance fees, because their alignment is then like greater AUM and not like getting a highest return or like doing the, that's why they maybe take calls where they, buy a large cap to reduce the volatility in the portfolio, go to cash. You can see those kind of divergences.
That's why, like having that backing on the passive side, one thing that happens is that your fees are also extremely, is probably like, half of what you would end up seeing in an active fund. Most passive funds would be charging you 0.3 or 0.4 odd % in terms of fees per annum. And in terms of an active fund could be 0.7, 0.8 if you're doing it directly, and then double if you're doing it through a regular scheme. So that's about like 1.3 to 1.5 odd %. So, I think so, to conclude on, at least my view is that the passive side could, show some large amount of outperformance because of process and fees both.
All right, time for scroll check. I've scrolled the internet, found some posts, and I want to see what you guys think. So let's start. Okay, so I think this is from an advisor. Everyone pushing direct plans doesn't understand value. My clients don't just get funds, they get hand holding, annual reviews, rebalancing advice, emotional support during corrections. The 0.5 to 1% difference is worth it for the peace of mind. Direct plan investors panic sell alone.
Yeah, I think Gaurav can take it.
So what we were earlier talking about is that, let's say 20, 25 years back, people were doing direct investments in stocks, and we've known that the result for that has usually not been great. But now there's a more systematic way of investing through mutual funds. Now the problem is there are so many mutual funds. What's the right one for you to be investing in? So I think an advisor is definitely helpful, who tells you how to allocate your portfolio, helps you review the portfolio within 6 months, every year. Tells you what segments might work, maybe because they have an indicator list that this is going to work in the next 6 months or next couple of years, or investing in something else. So all of that I think is extremely helpful. What is not helpful is, let's say you end up logging on a particular website and invest in a regular plan, and you don't know, you never get a call from the advisor. The advisor only calls you once you've put in a redemption request saying, but we are going to help you with like 2 3 more things. So that is not helpful. So let's say if you're going online, buying a particular scheme, I think that should be direct. But if someone's helping you do that, someone's directing you on what needs to be done, someone's reviewing your portfolio periodically, I think that should definitely be done through an advisor. And I would strongly recommend people to not take these calls by themselves, because see, the way we work also is, we have a team that gets on a call with people when they're investing. We do that with them. Within the first year, we end up doing an annual review with them. We keep telling them what is our outlook on the market. As we speak, as we'll come up with the portfolio review tool, within that we'll also come up with a set of quant indicators which will tell people about our thought process of why we are allocating what within what segment. So I think knowing that is extremely crucial. If your advisor knows where to be investing, definitely strongly recommend that you go with that person. But if you're doing it directly by yourself, just go with a direct plan.
Yeah, I think, one thing that I would like to add over here is, even when we are investing at Qode, a lot of our strategies involve buying ETFs, right? And what we've seen is that there's a skill to an advisor. The skill is to be able to read the market, to understand where allocation should happen. For example, personally, at Qode, what we were doing is that in 2024, there was no allocation, that was being made to the small cap side, right? And that was purely based on our research. So even when you're going with an advisor, understand that is the advisor actually coming with knowledge, or does he just have, an ARN number and he is just running this like
And
a
maybe
business,
getting
right?
higher fees for a particular scheme versus the other and trying to sell you
So
that.
interest alignment is important. Understand that, okay, is he coming from a place of knowledge, or is he just coming because he set up shop and he wants to be a mutual fund distributor? So that differentiation on your end should be done. Again, incentive alignment, could also be made out there.
I think this would be Rishabh's favorite question. It says gold ETFs saw 3.43 billion inflows in India in 2025, highest ever recorded. AUM now at $12.2 billion. Sovereign gold bonds discontinued. Gold at 1.14 lakh per 10 grams. Everyone laughed at gold bugs in 2022. Who's laughing now?
I think we read this all the time, right? Like the smartest investor has been the housewife, right? The Indian housewife who actually ended up buying a lot of gold, and that number has ballooned up. I think in terms of looking at gold, the lens that I think this is a question that we get repeatedly wherever we go, and I think the lens that you need to look at gold with is not from a wealth creation tool, just like you have to look at it as a storehouse of wealth. So there are different ways in which you can keep wealth. One is in the form of cash, which is currency, in your bank, in a fixed deposit, in equities, basically productive businesses, in real estate, and then there is the last piece, which is gold. The thought process with gold is that it hedges you against currency depreciation and also against inflation. So there are two things, right? If you look at gold long-term returns, forget the last 2 years, it's been exceptional the last 2 years. years. But if you look at gold, long-term returns have been about 11-12% per annum. You break that down. So on the MCX return is 11-12% per annum, rupee terms gold, and that is 3-4% is currency depreciation, 6-7% is inflation. That's the way I look at gold. Gold ends up doing extremely well in very high inflation environments. If you look at what Ray Dalio is doing today with his investments, also investing in gold and commodity driven businesses, because we might enter that high inflation environment whenever the US starts printing money. So I'm looking at gold from that lens. I'm not looking at it from any other lens. I'm not, you're not thinking of making a quick buck. It's more as an allocation to a percentage of your portfolio rather than it being, your entire portfolio.
All right, time for our next segment, which is answering the internet, where we've pulled questions from you, which have come in our inbox and our newsletter. So let's get into it. First question for you guys is, I have 8 mutual funds and just realized 4 of them hold the same stocks, something we talked about. Do I consolidate, or in some overlap is okay?
I think important to work backwards, understand what your target is, what's the objective with that mutual fund investing. Are you looking to grow capital at, say 25% per annum? Are you looking at this as retirement money? What's the thought process? And then work backwards. So if you are really aggressive and you're extremely young and you say that, no, my money should compound at 25% per annum, then you need to understand that the allocation needs to be concentrated in probably smaller mutual funds, guys who are allocating to small caps. Then again there could be someone who would say that my mutual fund investing is just a sort of creating a retirement fund. Then the idea is that let it compound at 12-14% per annum, and having that allocation to something like a large cap mutual fund will suffice. Having a diversified portfolio does not make any sense. I mean, it's just not logical to hold 4 mutual funds that end up overlapping, right? If that overlaps, so there is going to be some amount of overlap. You can't make it zero, but I think a good number would be like a 20-30% overlap and nothing above that. The moment it starts exceeding 40-50%, then it's not adding value to your portfolio.
So the next question is, everyone says expense ratio matters, but the difference between 0.5 and 1.5 doesn't feel like much. Am I missing something?
Yeah, I think don't look at it as 0.5, 1.5, look at it as percentage of the returns. I mean, if you end up making 12% per annum, 1.5% ends up being more than 10% of your total per annum return. So what matters at the end of the day, I think the expense does matter, but what matters at the end of the day is what is the CAGR of the fund. You won't know what the future is going to hold. That's why people like Buffett, Munger end up emphasizing on let's try and control the cost. And yeah, over a period of time, that cost and that number is going to matter. You can put that down on Excel sheet and you'll see a big gap between an 11% versus say a 12.5% return.
Yeah, in fact, let's say if you look at last 10 years, 15 years of data, where let's say it could be a regular scheme or it could be direct scheme. I don't think we have that comparison for active versus passive, but let's compare direct versus regular. You will see that there's a difference of close to 8 to 10% on the NAV as of now. So it does compound. That small number keeps compounding into a number. Now, in case of regular and direct, you can see that came to you as value. But in terms of a direct investment versus a passive investment, it's possible that they are getting you the same value. So why should I be paying a higher fee for an active mutual fund unless you're taking a call on the fund manager who's managing that fund? Let's say if it's a flexi cap fund, you want someone to keep moving around mid cap, small cap, large cap, and the fund manager can do that well, then that fees is well justified, but otherwise it's not.
So thank you, Rishabh and Gaurav. That was very insightful. I think we covered mutual fund itself in a quite detailed manner, and I think it'll be very helpful for our viewers.
Thanks, it was an interesting topic, Prateek.
Thanks, Prateek, for having us.
If this conversation helped you think clearer, please consider subscribing. And for more such market-related insights delivered straight to your inbox, hop on to our newsletter and stay tuned to Leverage by Qode.